4, you'll notice that a lot of these chapters kind of start out the same way. Like, okay, so who is covered under this particular law? In each of these chapters, we're talking about particular laws. Chapter 2, we focus mainly on the FLSA. Chapter 3, Social Security Act. Now we're going to focus on Income Tax Act. Okay, so federal income tax. So we need to determine who is covered as far as requirements for withholding. Okay, so obviously everybody has to pay income tax. If you make money, it is subject to income tax. The tax code says all income is taxable unless it's excluded. So you can assume, if you can't find anywhere in the tax code that says a particular type of income is excluded from taxation, it's included. Okay? So, and we're talking about income tax now. Before, in chapter 3, we were talking about Social Security and Medicare tax, which is based on income, but it's separate from income tax because those taxes go to fund specific programs. It has to do with where the money is going that's being collected. Federal income tax is being collected to fund the government because, gosh, it would just be terrible if they weren't able to do all the important work that they do. So we need to define who exactly is covered as far as withholding for those income taxes. Now, like I said, everybody has to pay them. Everybody is subject to them. As if you earn income, all that income is subject to them. But sometimes the employer is responsible for making prepayments or withholding for those income taxes. Sometimes if you're not an employee, then you personally are responsible for that. There are lots of different types of income as well. We've got retirement income, Social Security income, unemployment income, we've got dividend income, we've got interest income. There's all sorts of different types of income. What we're concerned with is wages. What are defined as wages? Because wages are the ones that is the income that requires withholding. Those other types of income may have withholding, but they're not required in most cases. For wages, we have to withhold. So we've got to establish what are wages, who is required to withhold them, meaning who is an employer, because if there's an employee, then there's an employer. And we already kind of covered a lot of this stuff in the last chapter with regard to Social Security. However, the rules on some of the rules are a little bit different when we define these. Also, we have to determine what are wages. We have to define what wages then are included in this and are subject then to withholding. Okay? Now, there are certain types of deductions that employees may participate in that would reduce their wages and then would reduce the amount of withholding. We're going to cover those in this chapter as well. There are some that reduce Social Security tax and Medicare tax as well, but then there are certain types of deductions that might reduce income tax, but not Social Security and Medicare tax. So they're mostly the same, the rules, until they're not the same. We're going to talk about that W-4. I already alluded to it, the W-4 form that is used. Employees fill them out at the beginning of their employment, but they can also fill them out at times, intermittent times while they're employed. The information on the W-4 form gives the employer the required information to know how much should be withheld from a paycheck. So we're going to look at that W-4 form. Then we get to the really fun stuff, and we're going to start computing federal income tax withholding. There are a couple different ways to do it, and within those, in addition to those couple of different ways to do it, then, as I had mentioned, we've got the pre-2019 W-4 form that where the factors that go into the calculation are a little bit different from the post-2019 W-4 form. Okay, so we've got like 4 different methods that we have to talk about in total. We're going to talk as well, look at the W-2 form. We already have talked a little bit about that W-2 form. That's the form that reports at the end of the year the total amount of income that the employee has received, as well as the different taxes that have been withheld. It also reports totals for deductions and all that stuff. So it summarizes everything for that calendar year. We are also going to look at information returns. Information returns are returns, they're not W-2s, but they do sort of the same thing in that they summarize all of the payments that have been made during the year for recipients of those payments. And then we'll also talk about the state and a little bit about the state and local. We'll take a look at Iowa, what Iowa does. We're not going to look at it at any other states, keeping in mind that Iowa is in the midst of a change with regard to income tax. Anytime you see a change in income taxes, a law has been changed that even if it's something that's not necessarily directly related to income tax, maybe a credit or a deduction has been changed. Every time that happens, these withholding calculations change as well. So you'll notice if you're an employee that your withholding may change, especially at the beginning of the year. If you're an employee, take a look at that. Pay attention to that. Look at your last pay stub for this year, and when it comes time to receive the first pay stub for next year, notice the change. There's actually going to be a big change this year because of all of these calculations, and the ranges that are used are based on, they change based on inflation. We've experienced a little bit of inflation this last year, right? Most that we've experienced in a very long time. So there are going to be some major changes to how much is withheld from employee paychecks starting in January. Okay, so so take note of that if you are employed, the difference there. That happens every year, but usually you don't see as big a change as what's apparently going to be coming up. We're going to look at, so when we look at the first we're going to look at the 2020 method, the new method of computing federal income tax withholding using the new W-4 form. Then at the end of the chapter, we're going to look at the old method. Okay, like I said, we've got to look at that old method because there are still individuals out there that are using an older W-4 form. Now, if you are newly hired or you fill out a new W-4 form, you have to use the new form. But there are individuals out there who still have on file their old form, even though it's been, 3-4 years now. Time to change them. Okay. Any questions on what we're going to talk about in this chapter? Okay, so let's talk about who is covered under federal income tax withholding laws. And that means, who is covered as far as required income tax withholding. I'm sorry, let me turn this on. It wasn't even going. Your book talks a little bit about these statutory non-employees. They're a very specific type of employee. Direct sellers and certain real estate agents fall under this category. They are kind of this hybrid between an employee and a contractor. So they do not have to have federal income taxes withheld from their payments. They do have to have Social Security and Medicare taxes withheld. They also report their income on a sole proprietorship form within the tax return, which means they can deduct expenses directly from that income. So that's the statutory non-employees. They're kind of this very tiny subset of workers that fall between independent contractor and employees. So the employer-employee relationship, essentially it's the same definition as what we had in chapter 3. So that's why they say just reference chapter 3. So you'll have to remember all of those different factors that go into that relationship. It's always going to be based on facts and circumstances. There's no clear-cut definition, but we're going to look at, we would look at behavioral control and financial control, and whether or not there are any other factors that, like a contract or something like that. But we wouldn't take one factor into consideration. We take all of them into consideration together. So that same definition, okay, that we looked at when we went through chapter 3. So we're not going to reiterate that. If you need any refresher on it, you can reference chapter 3 or go to the IRS website and just look up employer-employee relationship. You'll find all sorts of information on there. Types of wages that are then subject to federal income tax withholding. And again, all of the income is subject to federal income tax, but we're concerned with which income is subject to the withholding. That income that then has to be, is where taxes have to be paid at the time that the income is paid, okay? Wages and salaries, just like with Social Security. Vacation time, if you have vacation time that you're paid for, that is included. Any types of supplemental payments, also, back pay would be included. Severance pay would be included. Bonuses and commissions are subject to withholding. Tips, so we're back to the tips, ouch. Cash awards over, any types of cash awards that an employee gets. So if you get, $1,000 for meeting a sales goal, that's considered wages, going to be subject to income tax withholding. Taxable fringe benefits. There are certain benefits that when employees receive them, they're not in the form of cash. The employer is providing some other type of benefit, paying for that benefit on behalf of the employee. Some benefits are taxable. So even though the employee is not receiving cash, they still have to pay tax on it as though they received cash on the value of it. So, and we're gonna look at some specifics on that as well. Here are some specific instances where payments to employees are taxable, and just some details about each of them. I'm not going to go through all of them, but I will go through a couple of them. So drawing account advances. A lot of times salespeople they're paid a salary, but then they have commissions. And their commissions then offset the salary. So if they're paid a salary of $40,000 a year, when they receive commissions for sales, essentially that then reduces the salary. Well, oftentimes what happens is maybe, months are different. The amount of sales volume is different month to month. So if they don't meet their sales quota for the month, they're still going to get paid, but they're going to have to make that up in a future month. Well, those amounts, that's called a drawing account advance. So they're getting an advance payment on any commissions that they've earned. That is taxable. That is subject to income tax withholding. Gift certificates that are received by employees are considered to be cash. It's a cash equivalent, subject to income tax withholding. Meals and lodging. Again, we're going back to the meals and lodging if there's a difference between whether it's provided for the employee's convenience or for the employer's convenience. Same criteria are used. If it is included for the employer's convenience, then it's not taxable, not subject to income tax withholding. If it's for the employee's convenience, then it is subject to income tax withholding. Cash allowances for meals and lodging would also be taxable if it's provided for the employee's convenience. If it's provided for the employer's convenience, any amount over and above, any cash that's received over and above the actual expense, that would be taxable. So for example, they give you $1,000 a month so that you, they need you to live, live very close to the work location. They give you $1,000 a month to cover it. It only costs actually $800 a month. That additional $2,000, that part would be taxable. Okay, because it's additional income. Moving expenses. So moving expenses, this is something that changed in the tax law. It used to be moving expenses were not taxable. Now they are taxable. So if you have an employer that pays for you to move, even if it's for work, they want you to transfer, so you're working in Des Moines at Principal and they want you to transfer to their Denver office. And they're gonna pay for you to move out to Denver. They're gonna pay, maybe you've got a house and you're gonna have to pay realtor fees for selling that house. They're gonna pay those for you. They're gonna pay for the moving van to come pick up all of your household furnishings, take them out to Denver, get you set up in Denver. They're gonna reimburse you, pay you for mileage to get out there, all of that stuff. In total, it's gonna cost like $10,000. That's what they're gonna pay on your behalf, $10,000. Used to be that was not taxable income. Now it's taxable income. That could be a big chunk of change as well. So even though you didn't receive the cash, you received the benefit and you have to pay tax on it, it's subject to income tax withholding as well, okay? So that's one of those non-cash benefits. There is an exception for active duty military members. Although active duty military members, usually they're not subject to that provision. They don't have to pay tax on that. Let's see. What else do I want to say? Scholarships would be subject to income tax if they are paid, if there is some sort of work requirement included in that. So if you're, because then it's not really a scholarship. If you're paid for teaching or research as a condition of receiving the scholarship, that scholarship is now considered to be taxable income, because essentially what they're doing is paying you for work, right? It's not really a scholarship at that point. Sick pay is treated just like other wages. Supplemental unemployment compensation. Unemployment compensation, if you receive unemployment from the state, that is taxable, subject to federal income tax, and is subject to withholding. Travel and business expenses, and they mention here non-accountable plans. So there are two different types of plans that employers can have: accountable plans and non-accountable plans. An accountable plan means it's written up as a contract that the employer will reimburse you for any travel expenses, and it won't be taxable to you. If it's a non-accountable plan, or there isn't a plan in place, then it's taxable. It's considered to be taxable to the employee. All right, a few minutes left. Let's talk a little bit about fringe benefits. So fringe benefits, what are fringe benefits, first of all? So they're any type of benefit that the employee receives from the employer because of their employment status, right? Some fringe benefits are taxable. The value of them is taxable. Some fringe benefits are sheltered from tax and are not taxable. These are subject to income tax withholding, and they are taxable. So how do we determine, first off, what the value is? It's not cash, it's something else. We have to determine what the value of that item is. And we would use the fair market value of that item. So, try and think of an example. If an employer, well, gift card is a good example. If the employer gives an employee a $50 gift card, well, the fair market value of that gift card is $50. So that's the value that then would be added to taxable income and subject to income tax withholding. Certain other things are a little bit more difficult to determine the fair market value, but you know, whatever a willing buyer and seller would agree to is essentially the fair market value. So that's the amount. That fair market value is the amount that then is added to taxable income and is subject to income tax withholding. So by that I mean, if you have, say your wages are $1,000, right? And we're gonna do this. We're gonna be easy here and say that we have a flat tax of 10%. So the tax rate 10%. All right. So for federal income tax purposes, on that $1,000, we would withhold $100. So our net pay is $900. Let's just say that in addition to those wages of $1,000, we get some taxable fringe benefit. And the value of that taxable fringe benefit is $200. We didn't get $200, but we got something that has a value of $200. Now, our net pay, so now our total gross pay is $1,200 instead of the $1,000. We're going to apply the tax rate, 120. For taxes, tax withheld. Now, our wage of $1,000 is going to have $120 withheld from it. And we're going to receive $880. We didn't get that extra $200, but we got some sort of benefit that is worth $200. But we have to have income tax withholding on that benefit. So now we're paying an additional $20. We're having an additional $20 withheld from our pay. Okay, when it's a taxable fringe benefit. Some examples, tickets to athletic events. So if your employer provides you with season tickets to Iowa State football, determine what the fair market value of those season tickets are, and it would be added to your wages. You would have withholding based on that total amount as though you received the cash. Athletic club memberships, if the athletic club is not on the premises. So an example of that, I'm going to use Principal again as an example. They have a gym at their downtown office. Apparently it's pretty nice from what I hear. Employees are eligible to use that gym. Because it's on premises, the value of that membership is not added to taxable wages. There's a gym here, right? The Trail Point, whatever that is. If it were free to employees, which it's not, then because it's on premises, it would not be included in taxable wages. However, if it's an athletic club that is not on premises, so your employer provides you a membership to 24-Hour Fitness, then the value of that membership would be added to your taxable wages, and you would have income tax withholding based on that amount, the fair market value of it. Whatever the monthly $30 a month then gets added to your taxable wages. Personal use of a corporate car. If your employer provides you with a vehicle, maybe you are a salesperson and you have to do a lot of driving, or you have a lot of clients to see, and so the employer just buys a car and lets you use it. It's not your car, it's their car, but you get to use it. If you use that car for personal purposes, any personal use of that vehicle then is included in taxable wages. How do we figure that out? Usually it's done through mileage. You have to keep track of your business mileage and your personal mileage. And then the amount of personal mileage is multiplied by a mileage rate, which I think right now is 62.5 cents a mile. And then the value of that is added to your wages. So if you drove 1,000 miles and the per mile rate is 62.5 cents a mile, you're gonna have $625 added to your wages. And then you'll be taxed on that. You didn't get the cash, but you got the use of the car, which you didn't have to pay for, right? Frequent flyer miles. This one's kind of a hard one to keep track of, but a lot of employees do a lot of traveling for their job, and they rack up frequent flyer miles as a result of that. So maybe they always fly on Delta, and so they've got a Delta frequent flyer account, and so every time they fly, they get miles for that. The employer doesn't get them, they get them because they're the ones that are actually doing the traveling. The value of those frequent flyer miles that's a taxable fringe benefit that then is added to wages before we calculate withholding. Vacations. So some companies will provide vacations for their employees. Maybe they, instead of a bonus, they get a vacation somewhere. I know the company that my husband works for, he works for a law firm, and they provide, after you've worked there for 10 years, well, not to the attorneys, but to the staff, they provide them a vacation. They can go, they give them a choice of like 5 different places where they can go and travel, and they provide that to the employee. That's taxable. It's, if they gave them $5,000 and said, hey, go take a vacation, here's $5,000, $5,000 would be taxable. So just the fact that they're paying for the vacation instead doesn't make it non-taxable. So it gets added to the employee's wages. All right, so there are certain benefits though that don't have this treatment, that don't then get added to wages. Employee discounts, up to 20%. So if you work for a place that provides you a discount, so you can, you work for Trader Joe's, and they give you a 20% discount on anything that you purchase there. You don't have to pay tax on that discount. If it's over 20%, then it becomes a taxable fringe benefit. Use of on-premise athletic facilities, I mentioned that already. Reduced tuition, meals, and lodging for the employer benefit. So if your employer sends you out to, maybe they send you to a conference because they want you to sharpen your skills or learn something new that you can then use in your employment. Try and think of an example. They send you off to a boot camp to learn QuickBooks, something like that. The cost of that, because it benefits the employer, the cost of that is not included as a taxable fringe benefit. Okay, so if they have to pay for lodging, transportation expenses, meals, and all that stuff, you do not have to, that amount then is not included in your taxable income. De minimis fringe benefits, de minimis Latin for tiny, little. So things that are so small that it makes the administrative part of calculating it cost more than actually than the actual fringe benefit is worth. So personal use of a corporate cell phone. If your employer provides you with a cell phone and you use it personally, you don't have to pay. You don't have to have withholding on the amount of personal use like you would with a car. Okay, keeping track of personal versus business would be pretty difficult. And there is this circular E, which I think I've got a link to. I hope I've got a link to it in Blackboard. Let's see here. Yep, there it is. Okay, so 2021. Well, maybe I don't have the circular E. I'll put up a link to the circular E. This might be something you want to download because essentially everything that's in this chapter, well, and in the previous chapter too, is from this publication. It's just kind of presenting it in a different way. So the publication, they call it Circular E, publication 15. Let's see if they've got the PDF version. I want the PDF version. Nope, take me to the same place. There we go. Make sure though, if you're downloading it, we don't want this one. This one's for 2022. If you were working in payroll right now, this is the one that you would be using. You want the 2021, which the IRS site will have up, but for purposes of this class, you want 2021 because those are the brackets or the tax brackets and everything that we're using. Let's see. You can also go. Come on, I want prior year. All right, we'll go. Publications. They move things around on this site quite a bit. So we'll go under forms and instructions. Let's see. Here we go. Publications. So yeah, you are right. So okay, we don't want 1990. We want 2021. Okay, so maybe I need to put 2021. No. All right. That's weird. All right. There's got to be a better way to get there. Prior year. Maybe it's in here. It's 1040s, 941. There we go. Okay, so here's the 2021. I'll put a link up in Blackboard. This form gives you all sorts of information about withholding. This is a guide that's used by employers for determining. This is a great place to start if you have a question about a particular guideline for withholding at the federal level. And they also have information about federal unemployment tax, which is going to be our chapter 5 that we cover. So here you go. Who are employees? So employee status under common law. Statutory employees gives you some additional information about statutory employees that we kind of covered a little bit. Statutory non-employees, agricultural workers, treating employees as non-employees. You don't want to do that. You don't ever want to do that. Family relationships as well. family employees, talks about social security numbers, wages. So what do we count as wages? What are included? Here's some more detail about accountable plans versus non-accountable plans as well. Wages not paid in money. If in the course of your trade or business you pay your employees in a medium that is neither cash nor a readily negotiable instrument, meaning some other type of currency maybe, such as a check, let's see, you're said to pay them in kind. Payments in kind may be in the form of goods, lodging, food, clothing, or services. Generally, the fair market value of such payments at the time they're provided is subject to federal income tax, withholding, and Social Security, Medicare, and food taxes. Goes into more in depth about meals and lodging and all that stuff. So, I think this particular publication does not have the federal income tax withholding brackets or tables. That's going to be a separate form that we use. Oh, it's time. Okay, so I will go ahead and attach this. And we already went there. We will continue, I guess, at this flight 8 on Tuesday. Right? Have a good weekend.
Class today. Everyone looked back, you know.
What's that? Yeah, it was. I guess they're still worn out from the exam.